Very good morning to all of you. So, we are now in the last class and we are going to cover income from other sources. So, what has happened over the period? We covered two important heads of income. One is PGBP and another is capital gain. So, we are now moving on to the last head of income, that is income from other sources. So, I hope like all of you are now very comfortable. You understand whatever we discussed in PGBP and capital gain. And I'm sure you have also practiced with respect to these chapters for you to get a good control over the chapters. And it's also, as we have discussed, we said how much of PGBP you will be tested in intermediate and also in capital gain. So please restrict yourself to what is required for the examinations. I'll be very happy that if you have a complete control on the entire subject as a whole, but the first priority is your importance to your examination. So just look at what is required for examination, understand why the provision is. As we have been discussing, the why is very important. The logic behind why the provisions are in place. So the concept behind these provisions are very important. So with that, we will start with this current chapter of income from other sources. And this is also another important chapter, and there are some tricky provisions in this this particular head of income from other sources also. So what exactly is income from other sources? We'll fondly call it as IFOS, okay? We'll fondly call it as IFOS. So if you actually look at it, this IFOS is income from other sources. So what is it? How is it different from rest of the income? So it's very simple. It says, it can be any income or profit or gain, okay? Any income, profit or gain that is not included under other heads. That is not included under other heads. So what are they saying? It is an income. Everything is an income. Salary is an income. House property is an income. Your business income, profits are an income. Your sale of property, immovable properties and other things is a capital gain, is an income. So all of this is either an income or a profit or gain, right? But what is different in IFOs? It is different because it covers areas which are not specifically covered. So we saw there are charging sections, right? 15 for your income from salary. We saw 28 for PGBP. We saw 45 for capital gain. So all those are charging sections. So if it is not covered as an income under that respective chapter, then it will get covered under income from other, if it is still an income, okay? So when you say income under other heads, we all know what are the other heads of income. It is salary, house property, business or profession, and capital gain. So these are the four heads apart from your income from other sources. All these five heads is what you are actually calling as income that will be taxed in a particular previous year or an assessment year. So now what we are trying to say is what will be taxed under income from other sources. That is what will be charged under income from other sources is any income, profit or gains that are not includable in other heads of income, but chargeable to tax under the provisions of the Act. So what do you mean by that? It just says it is an income, but not covered under the heads, but taxable. So there should be a section which tells what are all the income that are taxable under this particular income from other sources. So it's typically when we discuss what comes to your mind, it's something like miscellaneous, right? So income tax, call it as a residual head. So it's basically a miscellaneous head. When something is not covered under everywhere, you put this income into this particular residual head. So this is what is actually is income from other sources in particular. Now, when you say income from other sources, we must understand what are the sections, what does it cover about? Typically, the word that we have been using is the structure. We saw in section 28, what are all income that are taxable. In 29, we saw a structure, how business income should be computed. Similarly, in capital gain, in section 48, we saw a structure. What did we say? Sale consideration minus expense, wholly or exclusively connected to the sale. And then you get net sale consideration. On that, you reduce what? Cost of acquisition or indexed. Similarly, cost of improvement or in long-term times it is index cost of improvement. So with that, you get capital gain, either short-term or long-term capital gain. So there's a structure. This is specified in section 49. Similarly, we need to understand what are we going to cover under income from other sources to have a complete understanding. So there are 4 sections that we are going to talk about. The first one is section 56, which is the charging section, which is what? The charging section. So this becomes your charging section, which tells you what are all taxable under section 56. That is taxable under the head income from other sources. Now moving on, we will have what? We'll have deductions allowable. So this deduction also allowable is what are all the expenditures that you can cover. It gets covered under income from other sources. That is deductions allowable. And when you say deductions allowable, we should also know what? We should also know what is not covered, what is not allowed as an expenditure. So section 58 talks about deductions not allowable, which you cannot claim for income from other sources. And finally, the structure, the deemed income. So if there is something still an income similar to section 41 in your PGP, where you say this is the deemed income, which talks about it is an income. Sometimes it's not covered in 56, but it will still be treated as an income under section 59. So this is what we are actually calling it as the structure of income from other sources. That is 56 to 59. 56 is what? 56 is your income chargeable under other heads. 57 is deductions allowable. 58 is deductions not allowable. And finally, you have 59 called as deemed income. It is similar to section 41. So as we said, this is your charging section. This is what is allowed. So this is what is allowed as an expenditure. So when you talk about it, you can claim this an expenditure. This is not allowed as an expenditure. So even if you have incurred, you should not consider it. Or if it has already been considered, you need to add back. And finally, deemed income. This is also an income. That is chargeable under income from other sources. So this is the complete sections that we'll cover. Now the structure. So typically it is the income from 56, income under section 56, whatever deemed income under 59. So you add that, and finally you less 57, whatever expenditure that is eligible for claiming under income from other sources. So all this put together will only give you income from other sources. So this is what we are going to discuss over a period. What we are going to discuss is what are all the income that are taxable under 56, what are all the expenses that are allowed under 57, what are all the expenses that are not allowed under section 58, and what will be called as deemed income. This is what we are going to cover across for today's session. We'll understand all these concepts. We'll start with 56. Okay, we'll start with 56. We'll try to understand what are all will be covered under income from other sources. When we say what all will be covered, we can bucket this into two heads. The first one is called, which is chargeable only in income from other sources. That is, irrespective of being covered in any other section. Even if you think it might fall under any other section, it should still be covered only under income from other sources, which is it. Even if you think it may fall under salary or PGPP or whatever, you should still tax it under income from other sources. So it is exclusive for charging it and only under income from other sources. Whereas the other categories are, it is not chargeable under other heads. It is taxable under IFOS only when it is not chargeable under other heads such as salary, house property, PGPP, and capital gain. So this is the categorization. This is the bucket that we are going to categorize. We are going to understand what is chargeable only in IFOS, what is chargeable in IFOS, if not chargeable under the other heads of income. So that is what we are going to understand in incomes chargeable under section 56. So what will get covered under chargeable only in income from other sources? When you say only in income from other sources, the first thing is dividend. Okay, I'm not going to explain you right now because, of course, we'll have slides typically to cover this particular point alone. So just to understand, we're going to cover dividend, casual income, we are going to cover share premium, we are going to cover interest on enhanced compensation, advances forfeited. We saw that in capital gain also, what happens to advance forfeited. So we'll discuss that here also. Then we have gift. and finally termination of employment. Now we are going to cover the six of this. Okay, 1, 2, 3, 4, 5, and 6 as individual slides, but we are not going to cover termination of employment separately. So I will explain it right now. So what does it say? It says compensation or any other payment on termination. So it is either termination of employment or modification of terms and conditions to the employment, to the any other contract. So now what exactly is this? Typically, what we are trying to say is, when there is an employment, it gets covered under your salary. But what if in a situation that you are receiving in terms of employment, but at the time of receipt, there is no employer-employee relationship. There is no employment-employee relationship. So typically, you are terminating an employee. For that, an employee is being paid by the employer. So at the time of payment, there is no relationship of employer and employee. So which means it cannot be categorized into salary under any classification of salary. It is not salary, it is not bonus, it is not your any allowances prescribed, it is not a perquisite, it is nothing. And moreover, there is no employer-employee relationship because it is post-termination. It is for termination. So anything for termination, compensation for the purpose of termination, or anything related to termination. It could be straight away termination, or at the time of termination, there is some modification for which he is being paid. So whatever it is, if it is due to termination, so this is only word that you need to remember. If it is due to termination, then it gets covered under IFOS, not your income from salary, because there is no employer-employee relationship. That is termination of employee. The rest of the 6 areas we'll discuss in separate slides. Now, after that, we need to understand what is not chargeable under the other heads of income. So if you actually look at it, these things, that is rent, machinery, plant and furniture, if not taxable under, let's say, if not taxable under PGBP, if not taxable, sometimes not under house property, in that case, it will be taxable. Similarly, rent inseparable, that is building and plant machinery furniture. Plant machinery furniture is inseparable. If it is inseparable, then it gets covered under income from other sources. If separable, building gets covered under house property, or plant machinery furniture gets covered under income from other sources. But if it is inseparable, you will have to treat the entire income under income from other sources. So that's the next thing. Then you have interest on securities. That is your interest income, family pension, keyman insurance policy, and finally residual income, everything which is not covered under. This head itself is a residual head. In that you have another head called residual income. So that is what is discussed in not chargeable under other head. So these are the income that are chargeable under income from other sources if not charged under other heads. So these are the 6 heads which are chargeable under income from other sources if not chargeable under the other heads of income. So that's what the law says. Okay. Now we are going to understand this in detail. So we'll start with what? We'll start with dividend. But before that, so what does it say? It says your chargeable only in IFOS is only here if not. So you can remember in this manner. So we'll start with the first concept of dividend. Okay. We'll start with the first concept of dividend. So what exactly is dividend? I will just first try to take you through the general definitions. Okay. What exactly it is defined. So let's take the language, for example. We'll take Oxford Dictionary, a most popular dictionary to refer words, or something like your Oxford, Cambridge are the most common dictionaries. What does Oxford says? It says a sum of money paid regularly, but they also say it is typically annually. So which means they say it's only once in a year, but they also use the word regularly by a company. So it is paid by a company to its shareholders out of its profits or reserves. Correct? This is a very basic example of dividend that all of us sitting here, all of us listening to this class will know what this dividend is. So it's paid out of profits from the company to its shareholders. When you say profits, it might also include reserves. Now, because profit represents current years, reserves represent what has been carried forward over a period. Now, what are the other definitions? So the Companies Act 2013 has also defined dividend. So what have they defined? They have defined dividend means the profit of a company. So they also say it is a profit of a company which is not retained in the business, which is nothing but what? It is distributed. So it is not retained. It is not retained in the business and it is distributed. Of course, if it's not retained, it has to be given away, but it is distributed only to what? Among the shareholders in proportion. They also go. The general definition does not prescribe about proportion and all. It doesn't talk about how much a shareholder should be paid, but Companies Act says how much a shareholder has to be paid. It says it has to be paid in the proportion of the amount paid up and the shares held by them. So if someone is holding 60% of shares, dividend should be 60%, correct? Dividend should be 60%. So what exactly are they trying to say? If the total dividend paid is 100, if one shareholder owns 60%, he will be paid rupees 60. Okay, 60. So which means it must be paid in that proportion of paid up share capital, not share premium, nothing. Only paid up on the shares held by them. So this is Companies Act. Now, if you actually look at it, the definition is a lot more wider. Okay, Oxford Dictionary is general. Companies Act is very specific about what exactly is dividend. But Income Tax Act has actually not defined exactly what dividend is, but they've given nature of situations. They've given situations which are defined. So it's not the meaning of the word dividend, but situations which will get categorized as dividend. Please understand the difference. It's a definition, but more of situations which will be categorized as dividend. So it is defined in section 2, clause 22. So what is 2? These are general definitions. So your income tax has wider scope and meaning in the act. What do you mean by wider scope and act? They have categorized us at 5 situations. We said Income Tax Act has exactly not defined. It has provided situations in which the distribution will be called as dividend. What? The situation in which the distribution will be called as dividend. So the first situation is what the Oxford Dictionary or Companies Act 2013 is referring. What does it say? It says distribution of profits by the companies to its shareholder. What do they distribute? They distribute the profit or reserves, which is nothing but the accumulated profits. They distribute it. In what ratio? In the proportion of paid up share capital. So this is what we mean by distribution by a company of accumulated profits. So this is general, very general, correct? So it's nothing different from what you saw in your Oxford Dictionary or your Companies Act. So that is the first category, first situation. Now we'll move on to the second situation. It is distribution of debenture or deposit certificates to shareholders. Now this debenture or deposit certificates are not exactly profits or reserves, but if that is distributed to the shareholders, then it will be called as dividend. Similarly, bonus of equity shares given to preference shareholders. So you give bonus of equity shares to preference shareholders. So this is also a form of dividend. What exactly that is debenture deposit certificate? We'll see a little detail in the subsequent slide. Right now, I'll just briefly explain what does this mean. And the third one is distribution on liquidation. So when a company is winding up, you remember section 46, we said what will be treated as capital gain at the time of liquidation, what will be treated as dividend, what will be treated as liquidation. You all remember section 46, we discussed what will be treated as dividend when at the time of liquidation, what will be treated as capital gain at the time of liquidation, and how do you compute that. We discussed that also under section 46. Now this distribution on liquidation isn't dividend income. Next thing, distribution on reduction of capital. So reduction of capital is nothing but, let's say a face value of share is 10. I might reduce the face value of shares, or I might reduce the number of shares also. So this reduction of capital is also treated as distribution of profits. And finally, any payment by a private limited, please understand private limited company. When I say private limited, let me rephrase it. The exact words in the book or the law is where public is not substantially interested. Public is not substantially interested. So the exact word used in the law or your book or whatever it is public is not substantially interested. So it is typically mostly a private limited company is what you call as public is not substantially interested. So we are trying to say a company in which public is not substantially interested. So here the condition is a shareholder is owning more than 10% of equity share capital. So at least 10% he owns. And in that case, any concern in which such shareholder is a member or a partner. So the amount is distributed to the shareholder or the related entity of the shareholder. And it could also be to any such company on behalf of or for individual benefit of any such shareholder. So it could also be paid by a private limited company, not to that person, but for the benefit of that person. What exactly is this? We'll discuss that in detail in a subsequent. So what do we understand now? There are 5 situations. First situation is straight away accumulation of profit. Second situation is distribution of something else, not a profit or reserves, something else. What are they? They are debentures or deposit certificates or bonus to preference shareholder. Please understand, it's not profit or reserves, it's something else. Third situation, at the time of liquidation. Fourth situation, at the time of reduction of capital. Fifth situation is any other thing which is paid by the private limited company. That is basically a company in which public is not substantially interested. So to a person who's a shareholder who's at least owning 10% or the related concern, or for the benefit of that individual or the related concern. So this is what you mean by dividend situations. So whatever you call, we are only going to discuss about the concept called accumulated profits, right? So we are talking about distribution of accumulated profits. Even in liquidation, we said, while we studied capital gain, we said up to accumulated profits, it will be treated as dividend. Above accumulated profits, it will be considered as capital gain. So that is what we discussed in your capital gain chapter also under section 46. So what do you mean by accumulated profits? Accumulated profits or profits till the date of distribution or liquidation. So whatever profits the company has earned over the period that is available for distribution at the particular date of distribution or the date of liquidation. So accumulated profits are nothing but current year profits plus previous year profits that are available for distribution on the distribution date or the date of liquidation. So this is what is about dividend. Now we will discuss each of these heads. So what first we said, it is accumulated profits. So we're going to understand what do we mean by this? Who should pay? How should it be paid? So now the first thing is we all know the distribution of accumulated profits, whether capitalized or not. So when you say accumulated profit, it could be capitalized or current year profit also. So the current year profits, apart from that, everything will be taken to your balance sheet. So over the period, whatever has been accumulated, the entire profit is called accumulated profits that is distributed by the company to its shareholder. Now, finally, how is it paid? It is release of all of any of its parts of assets. So they can use any of their assets. For example, money could be lying in your bank account. You could directly use that to pay off dividend, or you could sell some asset and pay it also. So finally, what we are trying to say is it is released from asset. When you say asset, it typically refers bank. Okay, bank or cash. So this is what you mean by release of all or any part of its asset. So you're releasing it from the bank or cash. Now, what do you distribute? You could either distribute directly the bank money, directly the money. In that case, whatever money paid, that is be it your bank. So in form of cash, whatever is paid in cash will be treated straight away. If it is not cash, if it is some other asset, the fair market value on the date of distribution. Very simple, right? So whenever you don't know the value, you take the fair market value on a particular date. In capital gain also, we saw this. that you take the capital gain, you take the stamp duty value on 1st April 2001. So this is what we understand, right? Similarly, we also understood about the concept of fair market value in capital gain. For your equity shares, long-term equity shares, we take the fair market value of 31st January 2018. Similarly, here, if you are not, if it is not cash, if it is some form of asset, then fair market value on the date of distribution will be considered as a dividend. So that is A, straightforward. I am distributing my profit or reserves. If I'm distributing through my bank account, then the cash itself. If I'm distributing by giving off any other assets, then the fair market value of such assets. The next concept, debenture, deposit and bonus shares. We said distribution of something else. It is not distribution of profits, it's something else. So it's not profits, but something else. But the distribution of accumulated profits, whether capitalized or not. So now what we are saying, it is to whom is it distributed? So here also, only to the extent of accumulated profits, it will be treated as dividend. Okay, it will be treated as dividend. So what are they saying? They are shareholder with or without interest. But to that shareholder, they're distributing debenture stock or deposit certificate. So what they're distributing is not asset, it's not an asset. They're distributing debentures, they're distributing deposit certificates. So which is also form of bank or cash only, right? So instead of giving cash, instead of giving asset, you're giving them debenture certificate, you're giving them debenture, you're giving them deposit certificate. So similar to fair market value, you identify the market rate or follow the valuation methodology prescribed in the Income Tax Act. So Income Tax Act as recommended or as prescribed valuation methodology for shares, debentures, everything. So that methodology needs to be applied if you are not able to obtain the market rate. So what do they say? They say if it is distributed to the shareholders, that is a debenture or a deposit certificate is distributed to the shareholder, then with or without interest, this particular proportion, the market value or the valuation of that particular debenture will be considered as dividend for that shareholder. The other case, if it is a preferred shareholder, we are not talking about equity shareholder, we are talking about preferred shareholders. For preferred shareholders, if you are distributing bonus shares, then the fair market value, very simple, right? Everywhere you take the fair market value if you are actually not able to understand the value. So the fair market value of the bonus shares will be considered as your dividend. So this is also whether capitalized or not. So this is about distributing of something else apart from assets. So that is the difference between B, A. So A, we said straight away profits through bank or through some assets. In B, we are saying I'm distributing accumulated profits, but instead of distributing the bank or cash or any other asset, I'm giving them additional debentures, I'm giving them bonds, I'm giving them deposit certificates. Then that will be called as dividend. Similarly, if it's a preferred shareholder, I'm giving them bonus shares. So the market rate or the fair market value will be the valuation for these methods. Okay. So now what? The next thing is we need to understand C. What did we say? The third situation, it is liquidation. So we have already seen this. In capital gain, and how do we treat under section 46? How do we treat? So typically, what are we talking about? We are talking about distribution attributable to accumulated profits. To the extent of accumulated profits, it will be called as dividend till the date of liquidation. So on liquidation date, whatever is accumulated profits will be categorized as dividend. After liquidation date, it will be taxable under capital gain. So accumulated profits, whether capitalized or not, again paid to a shareholder by a company during its liquidation. So how is it paid? The process starts immediately before the liquidation, and distribution made out of its profits Post liquidation is repayment of capital. So till the time of liquidation, whatever is accumulated profits is your repayment. Anything above that will be considered as repayment of capital. So that's what you distinguish between till liquidation and post liquidation. So that's what you're actually calling it. Okay. Moving on, the fourth category, that is reduction of capital. So what is the event? It is distribution of company only to its shareholders on reduction of capital. So they are actually what they're doing. They're reducing the capital, which means some part of the capital is repaid to the shareholder. So to the extent of accumulated profits, it will be treated as dividend. Everywhere, it doesn't matter whether it is capitalized or not. To the extent of accumulated profits, paid by the shareholder on reduction of capital. What do you mean by that? Let's take an example. C holds 100 shares of rupees 10 face value in ARC Limited. If the company prefers to reduce the face value to 4, they will return 600, correct, right? So they will have to return 6 rupees per share. So 6 into 100, 100 into 6 is 600, right? So 100 into 6 is 600. So this 600 is what is called as reduction of capital. If your accumulated profit is 700, then the entire 600 will be treated as your dividend. If it is less than 600, the difference. If it is 400, the 200 will be treated as the 400 alone will be treated as dividend. The 200 will be left out from this income from other sources. So that's what you're actually calling as reduction of capital. Clear? The last category, that is what? We have seen A, B, C, D. Now we need to understand 5. It is kind of important because it's a provision which is to fix a gap of misusing the concept of dividend. What exactly does that mean? Now, when we are talking about dividend, every time we said it is distributed to shareholder, and Companies Act 2000 went on to say it is distributed in the proportion. It is distributed in the proportion of the paid up share capital, right? Companies Act went on to add an extra meaning. What did they say? They said distribution of profits to the shareholders in the proportion of paid up share capital. Only then it has to be paid in that proportion. So what if only some of the shareholders are given some benefit, which otherwise is like distributing of profits, So the point I'm trying to convey is, instead of giving out profits, the company distributes something else, some form of benefit to selective shareholders. In that case, what happens? That particular portion will have to be treated as dividend. We are going to understand this concept. What exactly are they trying to say? To whom is this applicable? Are there any exceptions to this rule? So what are we saying? We are saying any advance or loan is paid to a specified person. Okay. So I am giving an advance or loan to one of my shareholders. So what exactly does it mean? My company's money is distributed. My company's money is distributed to a particular shareholder in the form of advance or loan, which otherwise would have been distributed as profit. So what are they saying? It is an advance by a company in which public are not substantially interested. So in other words, it's something like a private limited, something like not just private limited, but for your remembering capacity, for you to remember it easily, rather than remembering a phrase where you say public are not substantially interested. It's a very beautiful phrase in which public are not substantially interested. If you find it difficult, remember the word private limited. What do you mean by private limited? There is no public. So that's what you call it as public are not substantially interested. public or not substantial interest. It's a very beautiful phrase. Just keep saying it. You will like the phrase. So you will love that phrase by the way you say public or not substantially interested. So it is only applicable to that company. So advance, but however, it could be an advance or loan, but the limit here is it is only limited to accumulated profit. So if my accumulated profit is 10 and I am paying an advance of 12, the 10 alone will be treated as dividend and the 2 will be left out. So only to the extent of accumulated profits, and anything above accumulated profits will not be treated as dividend. Now, is it applicable to any shareholder? No, because when someone has the power to tell that you pay me alone, that person should have a good number of shareholding, should have a good influence. We all know these social media influencers, right? We all know Instagram influencers and in other social media platform who are called influencers, who can influence someone in a decision making, right? Someone can influence our favorite celebrity or whoever. If they show us a product, we will prefer buying. So they're influencing their decision. They're influencing their decision on us, correct? So if someone can influence me, they are called influencer. Similarly, in a company, if someone is ordering a company to pay advance to one particular person alone, that person must be influential person, right? That person must be an influential person, similar to an influencer So similar to an influencer in social media. So in this social media, we call someone who has more than 1 lakh followers. If I'm right, I think I'm right. More than 1 lakh followers will be called as an influencer. Similarly, here, anyone who owns more than 10% or more. So at least 10%. So in influencer social media, it is like more than 1 lakh, if I'm right. I'm just giving up a number. I'm not sure. So in your income tax act, the person who's called as an influencer, in this person is a shareholder who owns 10% or more of equity capital. Why? Because only the equity shareholders has the power to vote. Everyone else does not have. So that's why we say for such person, it will also include where such shareholder is a member or a partner and owns at least 20% share. So this person has control on another entity also in which he owns more than 20%. Remember 40A to be related party. We said common shareholding. In both the entities, the person has a substantial interest. Similarly, here we are talking about a shareholder who is owning more than 10%. Let's take, for example, A Limited. Okay, we'll take A Limited. So A Limited, there is a director called Mr. A. Now this Mr. A is a partner. Okay, partner in AB and Co. He owns 50-50. That is, A owns 50, B owns 50. Now, even if A Limited pays to AB and Co, it will be categorized dividend for A. So what are we saying? Even if it is paid to AB and Co. So just compare with the related party transactions of 40A to B that we referred. So similarly, here also we are talking about common shareholding. So one person owns more than 10%, at least 10% in a company in which public are not substantially interested. He owns also in another company. It could be any company. There is no restriction. It could also be a firm. In which he is a partner. Now, if this company is paying to this entity, the firm or the company, then this person will be treated, whatever is being paid to this person will be treated as deemed dividend under section 222E, will be treated as a dividend. So that is what we are referring to. Okay. So now this is the second situation. The third situation here, what we are saying is any such company on behalf of for individual benefit of such shareholder, of any such shareholder. So if this is proven, you need not prove any shareholding. If you prove that if A Limited is paying to AB and Co, for the benefit of Mr. A, it could still be categorized as deemed dividend under section 222 clause, subclause E. So what are we saying? We are saying an advance or loan is paid by a company in which public are not substantially interested, if such money is paid to a shareholder where that shareholder owns at least 10% as equity share capital, or to any concern where such shareholder is a member or a partner who owns at least 20%, then anything paid to that concern will also be treated as deemed dividend in the hands of that particular shareholder. And finally, any such company paying to another entity or anyone for the benefit of this individual, that is a shareholder or any other individual benefit, then that will also be called as advance or loan, that is as deemed dividend to that shareholder. So that's what we say. What about the exceptions? Now, let's say AB and Co. Is a consultant. Okay, AB and Co. is a consultant. So this consultant is now A Limited is a service entity. Now AB and Co. is providing consultancy services to A Limited, which is the primary activity. So A Limited to substantiate. So any advance or loan in the ordinary course of business. So for my business, I needed that advice from a consultant. I'm getting it from AB and Co. For which I am paying some advance to AB and Co. Now this advance is paid in the ordinary course of business. For example, if AB and Co. and A has an agreement which says, I will provide this service, I will provide an opinion on whether this income is taxable or not, whether this income is taxable under the Income Tax Act or not, what is the situation, what is the taxability. For this, the charge is 1 lakh, pay me 40% advance. Now, A Limited will pay 40,000 to AB and Co. for what? For providing this consultancy services, for providing an opinion on whether a particular transaction will be taxable or not. So for this, A Limited is paying advance. Now this is being paid in the ordinary course of business. So it's not something deviating from the business perspective. So it's in the ordinary course of business, and then it will not be covered. Similarly, if the business itself is lending of money is the business. So if it's a bank, if A Limited is a bank, A Limited giving advance to AB Limited or giving a loan to AB and Co. is completely okay, because again it is in the ordinary course of business. So an advance or loan made in the ordinary course of business, or where the lending of money is a substantial interest, only then it is not considered as a deemed dividend under section 2 clause 22 and subclause C. Now, loan treated as dividend and subsequently declares dividend. The point here is, let's say in April 22, okay, April 22, 1 lakh advance is paid, okay, from A Limited to A, okay, A Limited to A. So advance is paid by A Limited to A. Now, in June 23, okay, June 23 for financial year 2022-23, they are declaring a dividend of 1,50,000 to A. So this is dividend to A. Now, the actual dividend that will be taxable will be 50,000. How it is? 1.5 minus 1. 1,50,000 minus 1 lakh. So that will give you 50,000. So this 50,000 will only be taxed. That's why you say if loan treated as dividend and subsequently declares dividend in a subsequent year or whatever, then whatever has already been taxed as dividend will not be double taxed. So then only it will not be taxed. So that's the only point. So whatever is being distributed as dividend, only if the excess is distributed. So loan treated as dividend and subsequently declares dividend. So this portion, only that extra portion will be treated as your thing. And similarly, buyback of share. We spoke about reduction of capital. Reduction of capital is a dividend. But Buyback of share is not a dividend. Buyback of share is also, in a way, company is giving money to the shareholder, correct? In a way, company is giving money to the shareholder, but that is not a dividend. That is not a deemed dividend. Any distribution on demerger by the resulting company to the shareholders. So there is a demerger. The resulting company, that is the new company that will be formed after demerger, is paying to the shareholders of that demerged company. Then it is not deemed a dividend. So similarly, trade advance or commercial transaction. Whatever we said earlier only, the consultancy. So this and this are almost same. Okay, almost same. So they are same because both of them talk about ordinary course of business. In the first situation, a person in financial business, in lending business, gives some advance or loan, then it is not. Similarly, in the last situation, if it is a trade advance in a commercial transaction, as we said, service value is 1 lakh, pay me 40% advance. This is completely okay. This is completely okay. So trade advance or commercial transaction are also not considered as deemed dividend. So that is about your deemed dividend under section 222 clause C. Okay. So this is all about dividend under section 2 clause 22. So what does it say? It says we spoke about 5 situations. First one is accumulated profits. Second one is distribution of debenture, deposit certificates or bonus to preference shareholders. And the third situation is on liquidation. Fourth situation is reduction of share capital. Fifth situation is deemed dividend. That is any advance or loan to a shareholder. So that is fifth situation. These 5 situations is what is called as dividend under section 2 clause 22 of Income Tax Act 1961. See how wide the definition is, how wide the meaning is. It is completely different from what is discussed in your Oxford Dictionary or your Companies Act 2013. Now, the dividend could be various forms, right? The first is declaring dividend. That is something like your A. So you are declaring a dividend, you are straight away giving the dividend from the accumulated profits. Next is deemed dividend from A to D, whatever was discussed in 2 clause 22 from A to D, that is from accumulated profits, distribution of debenture, stock or deposit certificate or bonus to equity shareholders, your liquidation, your reduction in share capital. These 4 things are one category of dividend. And 222E, that is advance or loan to a influencer shareholder. So that is also called as deemed dividend. And finally, dividend could also be interim dividend. So all this dividend is currently taxed at the normal rate of tax. Normal rate of tax. Couple of years before or even before that, it was exempt. Then it was partly exempt. But recently, it is fully taxable at normal rates of tax. Normal rates of tax. So whatever slab it is applicable to the individual, it will be applicable to this dividend also earned under section 56 clause 2 subclause 1. 56 subsection 2 1 clause 1. So this is all about dividend. Now we'll see a problem to understand about this dividend. So the exercise 1 is from your study material. So Rahul is holding 28% of equity share. That is what? More than 10%. So this is greater than 10%, greater than or equal to 10%. In a company, took a loan of 5 lakhs from the same company. So he is taking a loan from the company. On the date of granting the loan, the company had accumulated profits of 4 lakhs. This is very important. Why? Because even if it's an advance or loan, only to the extent of accumulated profit, it will be treated as dividend. Others' money will not be treated as dividend. Now, the company is engaged in some manufacturing activity, which means their business is not lending business. So there is the amount of loan taxable as deemed dividend if the company is company in which the public are substantially interested. So what are they saying? Public or substantially interested. Public or substantially interested. So which means it is not at all applicable. So section 2 clause 22 subclause C is not applicable for companies in which public or substantially interested. Hence, loan received by Rahul will not be treated as deemed dividend. What would be your answer? If the lending company is a private limited company, that is a company in which the public or substantial. Even in this case, though the company is not a company where public is substantially interested, however, if the business, the primary business is lending business, hence the advance or loan will not be considered as your deemed dividend under section 222E. Okay, clear? So here Chanakya invested in shares and received dividend during the year at various devices. The point here that we are trying to say is, when is the dividend taxed? It is the year in which you receive, or in year which declare. So there are two words, right? Declared
recording in progress.
Extra money in the offer letter, but now they're changing the terms and conditions and then they're giving for termination. So everything we are speaking is about termination. So let's leave out anything else. So if it's something related to termination, whatever reason it is, then it will be called as, it will be covered under income from other sources. Vedant, what is the meaning of public is not substantial interest? I think I answered. So there are no, it is basically it is predominantly a private limited company, very closed group of company. So there are no external shareholders or whatever. So it's typically a private limited company. Dhyanesh, at the time of liquidation, if share capital returned to the shareholders by company, it is dividend income. We saw this in capital gain also. To the extent of accumulated profits, it is dividend. Anything above accumulated profits is like repayment of capital receipt that will be treated under capital gain. How the company can issue bonus shares to the preference shareholders? There are always this convertible preference shareholders. So at the time of conversion or something, they could give away with extra bonus also. Rather than just converting, they could give it with additional bonus also. Bonus given to equity shareholders is not dividend. It's not dividend. That will be treated under capital gain because we said bonus cost of acquisition will be zero. So whenever you are selling that bonus shares, whatever is that extra will be treated as your capital gain. Parthasarthi, in reduction of capital, they'll give in shares than cash. Yeah, they'll give in mostly in cash only, but sometimes it would be a split also, where they're just only changing the number of shares of the particular person. So it could be mostly in cash only. Sometimes it could be in shares also. So whatever is paid as cash only, we are talking as reduction in share capital. Pranav Ashista, if they're equity share and bonus share issue, then yeah. So for equity shareholders, bonus is not dividend. Abdul's loan is given to director and he is shareholder. After loan, he ceases to be a director. Is it still called dividend? It is only at the time of giving the loan. It is not subsequent days. So whenever at the time of distribution of loan, if a loan is paid to a shareholder who is owning at least 10% in a private company or typically a company in which public is not substantially interested, it will be called as a dividend. Dhyanesh, if a person have 10% or more in equity share and that person has substantial interest in any firm, company had given loans and advances to that firm, then that advance is deemed dividend. Who will pay tax on the dividend income? Chargeable income. It is a dividend of that shareholder. It is a dividend income of that shareholder. So in our example, we are speaking about Mr. A, right? Mr. A has to pay tax for that dividend paid, the amount paid to that AB and Co. I think my video stopped for a while. I'm not sure. I'll explain example 2 again. Or bonus issue considered as dividend. Or bonus issue, Anand, or bonus issue considered as dividend only if it is paid to a preferred shareholder. Otherwise, it is not dividend. Use of by company provide any foreign trip with an Indian trip to this dealer is taxable. We are talking about dealer distribution, right? So it is not about, it is not any form of dividend or whatever you have been explaining. I don't know what exactly you're asking. If your question is about whether that money paid to a dealer is taxable, it is form of PGBP, right? So it is a benefit to dealer that is also covered under your PGBP only. So nothing is related to income from other sources in what you're actually telling. So it is not taxable under income from other sources. So for I'll explain exercise 2 again, because some of you have said that videos buffering stopped and all those things. So exercise 2 is basically important point. I will not go through the entire exercise right away. What we'll try to understand is, when is a dividend taxable? When is a dividend taxable? A dividend is taxable at the date of declaration or the date of receipt. It is generally taxable at the date of declaration, not at the date of receipt. So only then you have to treat it. For interim dividend alone, it is not even declaration date, when it is the date in which it is, when the date in which it has the rights, the shareholder has the right to get the dividend. So that date. So in short, we can remember it as declared date itself. So whatever date is declared will be the date in which your dividend is taxable. Alok Shivlani, the last 4 questions of Capital, tell us the source of the question or upload answers. I think I've uploaded both. I've uploaded the slides and the notes. The notes will have the solution. The slides will have the problem. I think I've already uploaded for the session capital gain. So maybe you can look into that. Okay, so now we'll move on to the next category of capital gains. Sorry, casual income. I'm sorry, I'm still stuck with capital gain. So we'll move on to the next section of casual income. So the next category of income we are going to understand is casual. We said we'll understand 6. We have covered 1. We have 5 more. So next is casual income. So in casual income, these are the incomes that are covered under casual income: lotteries, crossword puzzle, races, your card games, or probably any reality games or whatever, gambling or betting, whatever it is. So all these games that are listed here is generally covered. When you say lottery, it is from draw or lots. What do you mean by lottery? It is by luck, right? By chance. So you just pick one number, and to that number you give money. So that is called lottery. Crossword puzzles. Sorry. Yeah, I'll make you host. Host or co-host? Okay. Thank you. So this casual income, whatever we have been discussing, is, we said there are 5 heads of thing. 5 heads of thing that we have covered. That is a lottery, crossword, race. What do you mean by lottery? Generally, you pick one random number and give prize to them, right? So you give reward to them. So that is called as winnings from lottery. Crossword puzzle is what you answer in this newspaper and other things. Races is all your horse race and other thing that is included. And finally, your card game and gambling or betting. So all this is what is covered under casual income. Why is it separately discussed here? Because it is taxable at a higher rate. It is taxable at a flat 30%. So there is no slab rate and all. It is taxable at 30%. Only thing you need to remember is no expenditure is allowed. So section 58, we said what are the expenditure that will not be allowed. So no expenditure or allowance can be allowed under this particular income, and no deduction under chapter 6A. So whatever deduction you're going to study a little later on chapter 6A is not allowed for lottery income. And similarly, no basic exemption limit. That is, the first to 2.5 lakh is not taxed, is not available for casual income. So it is straight away taxed at 30% without adjusting any expenditure. So that is casual income. So next is excess of fair market value. We are going to discuss 7B. So we were talking about various 6 sets, right? So now we have covered this. Now we are in share premium. So what exactly is share premium? Share premium is basically, we will take it this manner, okay? I will just explain you a situation and then come back to this. Let's say there is this A Limited, okay? And A Limited is invested 100% in B Limited. 100% in B Limited. Now, this A Limited, what A Limited is doing is, A Limited wants to give money to B Limited. A Limited wants to give money to B Limited. What are the possible ways? So either they render service, okay? Render service, which is taxable as income under your PGBP, or loan. So in loan, interest is taxable, correct? Interest is taxable. So in some form or other, it will be taxable in the hands of this A Limited or B Limited. So in some way, whatever money this B Limited is receiving, the render service will be taxable in the, I'll just, okay, for which A Limited will pay. So B Limited renders service to A Limited, for which A Limited is paying money to B Limited. Now this will be an income in the hands of B Limited. Similarly, A Limited is paying loan to B Limited. It will be taxed as interest in the hands of A Limited. So in some way or other, it is taxed either in A Limited or B Limited. Now to avoid this, what will happen is, B Limited issue shares to A Limited, because A Limited is the only shareholder. So they are issuing it to A Limited. What they do is, let say the fair market value, that is the market value of the shares, market value of shares is 25 rupees per share. Okay. But issue price, it is issued at a premium for 30 rupees. The face value is 10. Okay. So 10 rupee share as a fair market value of 25, but issued at 30. So now what is actually happening is 30 minus 10. Okay. 30 minus 10 is received by B Limited, not as an income, not as a loan, but as a capital receipt. So B Limited need not pay any tax on that. A Limited also need not pay tax on anything. So both the entities, both A Limited and B Limited, might avoid paying taxes on this situation, right? Because they're issuing beyond fair market value. So this 30 rupees, whatever, let's say they're issuing 10,000 shares, 30 into 10,000, whatever you receive will be used for B Limited's business, will be freely used. But it's not an income, it's not a loan. So then there is no requirement to repay, no requirement to pay taxes on that income. Clear? So this is the concept of 56 to 7B. 56 to 7B is typically because whatever excess beyond fair market value is issued will be treated as an income from other sources to that company. Now again, for this also, it is applicable only to company other than listed entities. So other than public company. So because public company is open, right? Anyone can buy, anyone can sell. So it is typically to private limited companies. So consideration received by a company from a resident in excess of fair market value of the share is taxable under this section. This section would apply where shares are issued at premium. So income under section 56 to 7B will be consideration received. The consideration received, in our case, it was 30 into 10,000, right? 30 into 10,000. So 3 lakhs. Consideration received is 3 lakh. But the fair market value is 2,50,000. That is 25 into 10,000. That is 2,50,000. Is that number right? Yeah. 3 lakhs, right? So 2,50,000. So what will be the income? 50,000 will be treated as an income in A Limited, in the hands of A Limited. So that is why it is called as capital in lieu of income. Rather than giving it as an income, rather than giving it as a loan, they are giving it in the form of share capital to support the other entity and escape from tax. So to avoid tax, they structure it in this manner to see to that there is no tax paid either by A Limited or B Limited. So that is the reason why it is there. So this is the concept of 5627B. Again, I'm trying to explain you why. So that you need not even remember. Very right, Royal, you can remember whatever is excess of fair market value is capital in lieu of income. So that will be taxable under income from other sources. So what is fair market value? We have already seen. So fair market value shall be the value determined, prescribed by the method. So income tax has prescribed a method, either on that method or substantiated by the company before the assessing officer. So company can substantiate before the assessing officer. See, it's not 25, it's 30 only. If the company can substantiate this before the assessing officer, then okay. So it shall be higher of value determined by the prescribed methodology or whatever is reported under the assessing officer. So typically, I may have higher than a fair market value, but I might be in a position to substantiate if questioned. So that's what it is. So computation of fair market value shall include everything, that is value of intangible assets, being goodwill, know, patent, copyright, trademark, license, franchisee, or any other business commercial right. So fair market value also includes the intangibles. Whatever we call it as intangible is also included. So it is so wide. The fair market value is computed based on the method prescribed by the Income Tax Act. So there is a method that is prescribed. That method will be discussed with you in what? In final. So that is not for intermediate. In intermediate, your question paper will tell you what is the fair market value. You only need to see whether fair market value is higher than the consideration received. If fair market value is higher than the consideration received, the difference will be treated as an income under section 56 subsection 2 clause 7B because it is capital in lieu of income. Clear? We'll see some examples to clarify this. A private limited, 10,000 shares, face value is 100, fair market value is 120, issue price is 130. So how much will something be taxable under 5627B? If so, what is the situation? So what is it? Fair market value, the issue price, the consideration received is greater than the fair market value. So 10,000 into 10. 10,000 into 10, that is 1 lakh, will be treated as an income under section 56 subsection 2 clause 7B because the share premium is excess of the fair market value. So that's what it is about. You should only consider the premium amount. Okay. Now, the second thing, B Limited, it is a public limited company. So it is not applicable because 5627B is only applicable to private limited company, typically a company in which public is not substantially interested. So if it is a public company, generally it is not applicable. Next is C, private limited. Your fair market value is 90, your issue price is 100. Again, it is your issue price is greater than your fair market value. But let's go back to that and understand. Excess of under this section would apply when the shares are issued at premium. When shares are issued at premium, only then this provision applies. So in this situation, what are we seeing? We are seeing 100 is greater than 90. That is, issue price is greater than fair market value, but the shares are not issued at premium. It is issued at the same price. 100 rupees shares are issued at 100. So 5627B does not apply at all because shares are not issued at premium. So it is not applicable. Here it is not applicable because it is public company. Here it is not applicable, not issued at premium. So that's the reason why it is not applicable. Next is D private limited, 40,000 shares, 100 rupees, 110. So here it is issued at premium. Here it is issued at premium. So 20 rupees, 20 into 40,000 will be treated. Then E Private Limited, 50,000. So that is 100, 120 and 110. So here it is less. So no issue. So it is 0. So it is applicable, but there is no taxability. Correct? So that's the reason why you have to do it. So this is what it is about. So here it is the entire share capital. It is 90 is more than 10. So the entire thing is distributed. Okay. So whatever is this is your 5627B. Clear? So any doubt on this? Okay. So now we will move on to the next concept. Yeah, Vedant A Limited will particularly be, yeah, shares, and these shares issued on premium will particularly be for A Limited. Yeah, it will be taxable in the hands of the company which issues the share. It will be taxable in the hands of the company which issues the shares. ₹10 per share taxable for which thing, Shivlani? Not issued at premium, no tax, no doubts. Okay, good. So good. So we'll move on to the next thing. So the next category is 8. That is, we are going to understand the fourth one. That is interest on compensation. So interest on compensation is the next step that we are going to understand. So now we have covered this also. We are now in interest on enhanced compensation. So the interest on enhanced compensation is typically 56 to 8. So what does it say? We already saw this in the chapter capital gain, where in section 45 we said in certain cases it is taxable on receipt basis. In certain cases it is taxable on receipt basis. We only discussed about enhanced compensation. But while discussing about enhanced compensation, we also discussed about this component interest on enhanced compensation, where we said 50% of this interest on enhanced compensation can be claimed as an expenditure. So, what is enhanced compensation? A particular land taken by the government as a compulsory acquisition. Compulsory acquisition, government gives certain amount of money. Let's say the land was worth 20 lakhs, government has given you 16 lakhs. So now you go before court and say, see, I wanted to get more. The value is actually 20 lakhs, but government paid only 16 lakhs. So now over a period, let's say the court case takes for 2 years. After 2 years, the government is being asked to pay the extra 4 lakhs. At the time of payment, this 4 lakh will be taxed as capital gain with respect to that particular person. But not only the capital gain, even the interest received for those 2 years will also be taxed under income from other sources. But that interest is not fully taxed. It is only taxed at 50%. So there will be a deduction of 50%. So what does it say? Generally, an income chargeable under PGBP or IFOS will be taxable in the manner of their choice. If it's an individual, it could either be taxed as cash or mercantile system. This is not applicable for companies and all, because Companies Act 2013 says you must follow accrual basis of accounting. So it is only for persons other than companies where they can choose which method to follow, cash or mercantile for PGBP and IFOS. But certain transactions can be only taxed on receipt basis, like what we saw in section 45. We said compensation or enhanced compensation can only be taxed in the year of receipt. Why? Because at the time of announcement of compulsory acquisition, you have not received the money. You can pay capital gain tax only in the year of when you have the money. So it is taxable in the year of receipt. So similarly for enhanced compensation also. So enhanced compensation shall be deemed to be the income in the year of receipt, and it is taxable. Such income shall be taxed under that income from other sources. So whatever you're talking about, the interest on enhanced compensation shall be deemed to be the income in the year of receipt, and 50% of such income shall be claimed as a deduction. So no other deduction is allowed. We saw in section 57 what are all the expenditures that can be claimed. We said those expenditure can be claimed, but what we need to understand here is for interest on enhanced compensation, nothing to worry about. Don't even think of what expenditure you made and all. Straight away 50% is allowed. It's like a standard deduction, or under your house property 30% flat, right, on your rental income. Similarly here it is 50% flat on the interest on enhanced compensation is allowed as your deduction under section 57. So that is interest on enhanced compensation or interest on compensation. The next thing that we are going to understand is the fifth one. The fifth one we are going to understand is advance forfeited. So advance forfeited, this also we discussed in capital gain. We said till 31st March 2014, it is supposed to be reduced from the actual cost. So whatever is your cost of acquisition will be the actual cost minus the advance retained. So that is till 31st March 2014. But from 1st April 2014, it shall be taxed as income from other sources under section 56 to 9. So this will be treated as income from other sources. Indexation benefit would be on the actual cost. So what is the shift? Earlier indexation would be on the adjusted cost. But nowadays, that is from 1st April 2014, the indexation will be on the actual cost. So for capital gain, indexation will be on the actual cost. Whatever is advance forfeited will be treated as an income from other sources, and it shall not be reduced from the cost of acquisition. That's a shift. So for exam purpose, from 1st April 2014, this is IFOS. So these are all the incomes that are straight away taxable under income from other sources, irrespective of your business income or any other nature of transaction they're doing. It is straight away taxed only in income from other sources. So that's what it is being discussed here. So that is advance forfeited. Okay. With this, what we'll do is we'll take a short break of 10 minutes. So we'll resume after that. We'll resume with the next sections. Okay. So we'll see after a short break. Thank you. Sorry? Yeah. Okay. So welcome back. So we have covered as we were talking about, we were covering various chapters, various sections which discuss about what is taxable only under income from other sources. We discussed dividend, casual income, share premium. We also completed these two, correct? So the last one left is gift. So whatever gift is what we are going to discuss right now. So what is a gift? Gift is basically like we all give our friends, family, like during birthday, during wedding and all those things, right? So you gift. So gift is basically, in real terms, you give someone something without receiving any consideration, Now, the law says this should not be misused. To say that it may end up like a tax escapism. So what it says is, some of the situations, as far as gift is concerned, income tax is, it is taxable. It is an income to you. So they are categorizing into three buckets. First is any sum of money. That is basically you're receiving cash. Second is, it is relating to an immovable property. So first is money. Next is immovable property. Next is any property other than the immovable. So typically what? Movable property. So sum of money, immovable property, movable property. They're categorizing into three categories. So gift categories are three. And in this three category, to understand what is actually a property, because the first one is money, but the second and third talks about the word property. So what exactly is property? So that has been defined in 56.2.7. 56.2.7, it says immovable property being building, land, or both, and then shares or securities, jewelry. These from here to here, it is all these personal assets which are actually taxable. When we saw a definition of capital asset under section 2, clause 14, we said it does not include personal assets, but for jewelry, archaeological collection, paintings, drawings. I'm sorry, painting, drawings, sculptures, and any work of art. These are the things that we discussed in capital gain. So they are also covered here. And then bullion. Bullion is basically a type of commodity. Okay, so commodity, and as we say, share security, we also include bullion, so it includes commodity. So now all of this will be considered as property. Only if it is a capital asset and not a stock. So if it is a stock, this provision does not come into picture at all. For 56.2.10, stock does not come into picture. What comes into picture is only the capital assets. If a land or building is treated as capital asset, a share is treated as capital asset, jewelry, bullion, your painting, drawing, work of art, whatever it is, if it is treated as capital asset, then it will get covered into the definition of property. Okay, now we will see these three categories independently. We said there are three categories: any sum of money, then we said value of immovable property, and then value of property other than immovable property. So we'll first start with any sum of money. So what do you mean by any sum of money? A person, okay, a person receives any sum of money without consideration. So the crux, the base of this entire portion is without consideration. So for no services provided or goods sold. So nothing is happening, but I'm receiving a money. It could be for my birthday, it could be for my wedding, it could be for any occasion. So for anything and everything, if I'm being given some sum of money without any consideration, so I don't do them anything, but they give me money, then it becomes taxable under this section. But just because someone is giving you gift, you should not be taxed. So what income tax has done is they have given a limit. What limit it is? 50,000 in a year. 50,000 in a year. So it is taxable only when the sum exceeds 50,000. Please understand, it is not what exceeds 50,000. What is taxable is the aggregate value, which means the total value. So if you receive 51,000, what is taxable is 51,000, not 1,000. So the aggregate value of the sum of money received during that particular year, which is when the sum exceeds. So it's not excess of 50,000. So the entire money. So the limit is prescribed is not per person. So it is not per person. So the total gift. So what you need to do is you have to compute the total gift received during the year. If it crosses 50,000, it is taxable. It is taxable under the income from other sources. So sum of money has not been defined in the Act. So it may or may not include cash equivalents. So there is this debate. Okay, there is this debate. When you say sum of money, do you actually mean straight away bank or cash? Or let's say you are transferring a fixed deposit. Is that covered under fixed? It's not a share, it's not a security, it's not a bullion, it's not covered under any of them which is listed as property. So if it's fixed deposit, I'm gifting this fixed deposit to a particular person. Will that fixed deposit be covered as sum of money or not? This is a question. Now income tax says, I am not defined. So you are free to decide. Okay. So typically what would income tax expect you to believe that fixed deposit also is a sum of money. But as an assessee, you will try to keep your income low. So you will say sum of money does not include fixed deposit. So there are two views. Things like fixed deposits or sum of money, or it's not sum of money. So you can take either view in your income tax, but write your assumption in the note, in a reference. So my suggestion would be consider it as a sum of money and write it in the note, saying that sum of money is assumed to include cash equivalent. Hence, fixed deposit has been considered as an income from other sources, taxable under that income from other sources. So if you write this, as I told you, the valuer will know that you know the provision. What? Valuer will know that you know the provision. That is the ultimate objective while writing income tax or any law paper. You should let know the valuer that you know the provision. So that happens through clear notes. So for this also, since there are two views, you can always pick a view. My recommendation will be to pick a view that it is taxable. So you say that fixed deposit is considered as cash equivalents and treated as sum of money. So you can write this and then prepare your solution. So that is about sum of money. Okay. Now we'll move on to the third category before stepping on to immovable property. We'll move on to other category, that is any other property. Now, when you say any other property, we spoke about share, security, jewelry, painting, drawing, any work of art, all those things, right? Now, that could be given with consideration, without consideration. Now, when you say with consideration, they are trying to say that low consideration. Let's say I'm transferring it to my friend. I say, see, you are a very close friend of mine. This actual value of this is 10 lakhs. You don't give me 10 lakhs. You give me 8 lakhs alone. So what happens is the difference of this 10 lakhs and 8 lakhs will be considered as an income from other sources in the hands of the seller. So in this case, I am the seller. So I will be taxed at 10 lakhs. That is, I will be taxed at extra 2 lakhs and I will not be taxed at 0. So whatever is excess received will be considered. Okay. Now, what if it is without consideration? So let's say you take the fair market value of the property received as your income, but the fair market value is less than 50,000. You have to ignore it. That it's no income from all sources. So it's not aggregate like your gift in your any sum of money. Here they are saying the fair market value of the property transferred is not more than 50,000. So up to 50,000 it is exempt. If it exceeds 50,000, only then it becomes an income under income from other sources. Similarly, with consideration, it is taxable. Only if the difference is in excess of 50,000. So the same concept. Okay, we'll assume the formula is fair market value minus consideration. Okay. Now, when it is with consideration, my consideration will be some amount, right? But if it is without consideration, my consideration will be 0. This is without. Let's say my fair market value is some value, right? So nothing but I'm reducing 0. So here, if my fair market value is more than 50,000, it is treated as income from other sources. But in this case, if it is excess of 50,000, in both cases, it is excess of 50,000 only. So that doesn't change. Just that fair market value minus consideration should be more than 50,000 for it to be treated as income from other sources. In a case where it is without consideration, automatically the consideration will be zero. So they say that the entire fair market value will be considered as income from other sources. But otherwise, the formula doesn't change. It is fair market value minus consideration, whereas the consideration is zero in without consideration. So that's what it is about. So if the difference of this is more than 50,000, the difference of this is more than 50,000, then it will be considered as income from other sources. So whatever is in excess of 50,000, this is per transfer, per gift, not the entire thing. So that's what it is about. So this is from the buyer's perspective. For seller, it will get covered under capital gain. For seller, it will be considered under capital gain. Here we are talking about from the buyer's point of view. So this provision is for buyer. Seller gets covered under capital gain. So the next thing, we'll move on to the immovable property. Here also it is with consideration, without consideration. Now, if it is with consideration, instead of fair market value, we are replacing the term stamp duty value. Instead of fair market value, we are replacing the term stamp duty value. So it is SDV minus consideration. So if it is without consideration, it is straightforward, greater than 50,000. Okay. But if it is with consideration, it is 50,000 or 10% of consideration, whichever is higher. When I say 10%, what strikes your mind? When I say 10%, what strikes your mind? Do you remember anywhere else where we saw a similar provision about something like this? 10%. Stamp duty value, the word stamp duty value, the word 10% of consideration. Do you remember any other section? Correct. We remembered section 50C, where if stamp duty value is less than the sale consideration, then stamp duty value will be considered as your full value consideration in your capital gain. But if it is within 110% of the consideration, what? If it is within 110% of the consideration, then the sale consideration, actual sale consideration itself will be treated as full value consideration. We studied this in 50C, same provision. What does it say? Instead of 110%, they're using 10%. So stamp duty value minus consideration. If it is less than 10% of consideration or 50,000, whichever is higher. Here, the only additional point is this 50,000. There is only 110%. Here it is 10% of consideration or 50,000, whichever is higher. So that is what is being prescribed. So typically the cutoff that you can remember is 5 lakhs. So if the difference between stamp duty value and consideration received, that is, if the consideration is 5 lakhs, okay. So 5 lakhs, then the 10% of 5 lakhs is 50,000. So up to consideration of 5 lakhs, it will be always 50,000. Above 5 lakhs, if it is above 5 lakhs, this will not be applicable. This will not be applicable in this case. That is above 5 lakhs. So for consideration above 5 lakhs, it will be flat 10%. So that's what we'll do. So I'll just show you an example for this. So let's say my consideration is 4,50,000. Okay, 4,50,000. My sale value, fair market value, right? Sorry. So my fair market value is, let's take about 5,20,000. Okay, 5,20,000. Now I'll have to compare 5,20,000 minus 4,50,000. Now it is 70,000. But what is your 10% of consideration? 45,000. So the provision says if 70,000 is greater than 50,000 or 45,000, whichever is higher. So which is higher? 50,000 is higher. So it is 70,000 greater than 50,000. Hence, the sale consideration will be fair market value. Hence, the sale consideration will be the fair market value. So that is in capital gain. Here, this 70,000 will be considered as income from other sources, nance of buyer. So that is the question. So whatever is the difference will be considered as your income from other sources. So it is not excess of 50,000, the entire difference. So 50,000 or 10% consideration. But if my consideration, if in this case, my consideration is 5,10,000. Okay, in that case, my 10% will be 51,000. So it is 51,000 or 50,000, whichever is higher. It will always be this. Why? Because my consideration is more than 5 lakhs. So that's why I say you can keep a cutoff of 5 lakhs. So if my consideration is more than 5 lakhs, it is 10% of consideration. If my consideration is less than 5 lakhs, then it is 50,000. So up to 5 lakhs, you can take 50,000. Above 5 lakhs, it is 10% of consideration. So that is what about this with consideration. Without consideration is simple. Similar to what we saw in C, that is for value of other property without consideration. Fair market value minus consideration. If it is greater than 50,000, it will be treated as income from other sources in hands of buyer. So here we are taking 50,000 or 10% of consideration. Take whichever is higher. See to that whether the difference is more than that. If difference is more than that, the difference will be treated as income from other sources. Else, the taxability is zero. Nothing is taxed. Okay. There is a relaxation. The relaxation is instead of 10%, 20% is applied. Instead of 10%, 20% is applied. If it is a residential unit that is transferred between 12th November 2020 to 30th June 2021, and if it's a first time allotment and the consideration is less than or equal to 2 crores, Clear? So in this situation, it is not 10%, it is 20%. Do you remember this 2 crore anywhere? 2 crore anywhere? Consideration, the 2 crore was discussed in capital gain chapter. What section? Section 54. We said if the capital gain is less than 2 crores, they have the option of buying 2 properties and they can choose once in a lifetime. See, I'm comparing numbers, I'm comparing provisions, I'm comparing everything for you to link and remember. By linking and remember, you tend to remember for a longer time. So this is another provision. Okay. So this is the relaxation. So what is it? It is between your any immovable property with consideration, without consideration. It is 20% if they satisfy this condition. Clear? So we'll move on to the next step. Okay. Next step is basically whatever we discussed in capital gain. What did we discuss? The stamp duty value should be considered on the date of agreement or date of registration. So if whole or part of the consideration is there anything, then SDV on agreement date. So you need to consider agreement date if at least some part is paid in banking mode. What is banking mode? All this are banking mode. And if it's not, even if some part is not paid in banking mode, then it's STB on registration date is what is considered. So if the stamp duty value is disputed, we saw that in capital gain also, you may refer a valuation officer. The assessing officer will refer a valuation officer and assessing officer value less than stamp duty value, whichever is that. So what is this? This also, both of this we discussed in capital gain. This part, you can basically leave it because it's more important in final. more important and final. So you can actually ignore an intermediate. So as far as intermediate, if some part of cash is paid at the time of agreement, it is agreement date. If some part, none of them is paid in banking mode, then it is registration date. That stamp duty value only should be considered. The next concept, whatever we discussed right now, the three categories, that is sum of money, value of immovable property or movable property, the provision of 56(2)(7)(b), 56(2)(10) will not be applicable. 56(2)(10) will not be applicable if the money is received, the property is received from any relative, not taxable, because it's a gift between relatives. Marriage of individual. Remember the word marriage of individual, not son's wedding, daughter's wedding, nothing like that. It is marriage of individual under a will or inheritance. So from father to son, and go on, right? So that is will or inheritance. On a death, going to legal hire, transferring to legal hire, it's not covered. From any local authority, so government bodies transferring assets is okay, which is basically what local authority is transferring to someone is okay. Any institution, any trust, what is an institution? So typically when you say institution, these are fund, foundation or education or medical or hospital prescribed under section 10, clause 23C. And what is a trust? It is a trust registered under section 12AB, created by the individual for the benefit of relative. Created by the individual for the benefit of the relative. So this trust is also is ignored. Not a transfer under section 47. Whatever we saw, it is not a transfer under for section 47. Amalgamation to subsidiary, demerger to resulting company, through succession or gift or will or inheritance, all those things. So whatever is not a transfer under section 47, that will also be not covered under this one. And then prescribed person. Who's a prescribed person? Government may announce an additional class of persons with additional conditions. So all of this is excluded from the concept of 56(2)(10). So if a person is giving gift to a relative, a person is giving to another person on the occasion of marriage, on the occasion of it is being transferred through will or inheritance, or through on the purpose of death, on the event of death, or from any local authority, registered approved institutions, registered trust, not a transfer under section 47, such as amalgamation or demerger or whatever it is, and any other prescribed person. So all this transaction will not be treated as income from other sources under section 56(2)(10). And who's referred as relative? Relative is basically, in case of an individual, spouse, brother or sister of the individual, brother or sister of the spouse of the individual. So brother or sister of the spouse of the individual, brother or sister of the either of the parents. Okay. So uncle and aunts, either of the parents, any lineal ascendant or descendant, any lineal and descendant of the spouse. So both lineal ascendant and descendant of the individual, lineal ascendant and descendant of the spouse. Spouse referred to in item B to F. So when you say brother or sister, it includes brother spouse, sister spouse. When you say spouse brother, their spouse is also covered. So whatever we have covered here, it includes the spouse of this person also. In case of HUF, any member thereof HUF. So this is what you mean by relative. So if any money, any property received from this person is not taxable under income from other sources because it is a gift out of love and affection. So it is not included. Clear? Next. Whatever we saw right now has undergone an additional amendment. So now what we are going to see is few more instances where 56(2)(10) will not be applicable. So it is not applicable if money is received by an individual from any person for medical treatment of COVID-19. It could be self or family. What is it? For COVID, if someone is being paid, the person who is receiving is not subject to income tax. That is, it is not taxable under income from other sources. Similarly, any money is paid to a member of the family of a deceased person. deceased person from employer. From employer. So employee has passed away. Now the deceased person, the member of the family of the deceased person is receiving. Next, member of family or deceased person from any other person. So someone is giving money for someone's death. Let's say government is giving. It could be government also. So up to 10 lakhs, it is not taxable. But death, okay, what causes death? What causes death? What causes death is basically COVID-19, for COVID-19, and payment should be paid, should actually be received by that individual within 12 months from the date of death. So within 12 months from the date of death of COVID, the money should be received by the family member of the deceased. Only then it is applicable. So for general employer-employee, no limit. But if it's a stranger, up to 10 lakhs, it is not there. So what do you mean by family? Spouse and children. If it is dependent, if it is others, then it is dependent parents, brothers and sisters. So for them is what is get covered into self or family. Okay. So this is what you mean by non-applicability. So this is amendment in this particular year. So for your examination, this amendment. So when you talk about amendments, see, as far as this income tax is concerned, amendments are very critical because your questions, like at least 10% of the question will be relating to amendment. So when you say amendment, it is primarily current year's amendment, that is Finance Act 2022. To some extent, you should also know the amendments of Finance Act 2021. So in short, I can say last 2 years amendments giving importance to current year amendment. This is very important for your examination. Okay, so with that, we have covered this 56 to 10 gift related number. Okay, so we will see a small illustration and then go back to any questions or something. So what is 56 to 10? Mr. A is a dealer in shares. So he is a dealer in shares. Okay, the following without consideration. So he has received following without consideration from his friend. Is friend a relative? No. Okay. Mr. B, cash gift of 75,000 on his anniversary. What occasion? Anniversary. So what did we say? Exemption. We said if it is marriage of the individual. So now is this covered? Not covered. It is covered. That is, it is an income from other sources because it is more than 50,000 also. So this 75,000 is an income. So I'll add plus. So it is an income. Bullion. Bullion is a property or not? Bullion is a property. Fair market value of 60,000 on his birthday on 19th June. So occasion is birthday. There is no exemption for birthday. So it is taxable. So bullion is also a property. So this must be taxed. But it is not sum of money. We should see aggregate separately for sum of money, separately for the other properties. So as far as the property is concerned, for each property, if the market value is more than 50,000, the entire amount will be treated as gift. A plot of land, which is covered under immovable property. The stamp duty value is 5 lakhs. The stamp duty value is 5 lakhs. On that date, Mr. B had purchased the land in April 2009. It doesn't bother when B purchased and all. Currently, A has received in July 22 for stamp duty value of 5 lakh. And there is no consideration paid. So the entire 5 lakh will be taxable because it is paid by a friend, not by any relative. So this is also an income. Now, Mr. A purchased from his friend, Mr. C, who is also a dealer in shares, 1,000 shares of X Limited at 400 each on 19th June 2022. The fair market value is 600 per share. The fair market value is 600 per share. Mr. A sold these shares in the course of business on 23rd June. So it's a business transaction. Now we need to see whether even in business transaction, this excess needs to be covered. Further, on 1st November 2022, A took possession of property, building booked by him 2 years back. So he has actually booked by him at 2 years back, 2 lakh. The stamp duty value of the property as on 1st November 2022 was 32 lakhs. And on the date of booking was 23 lakhs. So on 1st November 2022 is 32 lakhs. But but on the date of booking, it was 23 lakhs. He had paid 1 lakh by account payee check as down payment on the date of booking. On March 2023, he sold the plot of land of Faridabad for 7 lakhs. So now they want us to compute what? Both, right? So that is both income from other sources and capital gain. So this is what should be discussed right now. Now, what we need to discuss is first is capital gain, right? So we have property sold and all. So whatever is discussed in capital gain and income from our sources needs to be computed. The first step is, of course, capital gain. So we can compute capital gain also. So we'll start with capital gain. Computation of capital gain of Mr. A for assessment year 2023-24. As we told you, I have a particulars column. Amount. I'll add another amount column if required. So you can go through the question and see whether an amount column will be required. So I'll draw the margins. So I'm first starting with capital gain because that is the first state that comes before income from other sources. So it's always better to follow the order of the heads in which we study. Okay. The first thing what we are saying is, as far as this building goes, it says that there is a first number on the date of booking is given on 1st March 2023. That's the first time he's selling a capital gain because sale of shares on 23rd June 22 is dealing in shares. So he himself is dealing in shares. So this will not be a capital gain. So this will not be a capital gain because it is part of your business income. So what we need to do is we have to write straight away talk from the Faridabad land only. So we take the sale consideration. Sale consideration is 7 lakh. There's no expenditure giving. So you straight away go to cost of acquisition or index cost of acquisition. So this Faridabad land was sold on 1st March 2023, whereas it was purchased on land, a plot of land and the stamp duty value. So it was gifted by him. So basically, it is gifted from this person, right? It is gifted from this person on 5 lakhs on 1st July 2022. So it is gifted from a friend. It is gifted from a friend. So it's not gift, inheritance, succession, nothing. So the year will become only 1st July 2022. So whatever I purchased in 1st July 2022, I am selling it in 31st March 2023. So the due date what I need to take for cost of acquisition is only 1st July 2022. The stamp duty value was 5 lakhs. Stamp duty value, that is cost of acquisition, is 5 lakhs. So capital gain, right? That is short term. Will be 2 lakhs, correct? So that will be a short term capital gain for 2 lakhs. So whatever is required here, that ends your concept of capital gain, right? Capital gain computation gets over by this. Okay. So now, whatever we are talking is the next thing, that is income from other sources. Okay. So now computation of income from other sources of Mr. A for AY 2023-24. Again, I start with particulars, amount and reference column. Okay. So particulars. So again, I'll have two amount columns, one reference column, because note is very important. You can write as much as possible. Even in the above, you can say the stamp duty value of what is being given was considered as sale consideration, whatever. Because we are saying stamp duty value here, rather you can write cost of acquisition, write reference one. In the below, you can write stamp duty value shall be deemed to be the income for the gift received by Mr. A. Because as for 56,210, whatever is the stamp duty value will only be treated as the income of that particular person, right? The buyer. Okay, now whatever I have, I'll start with one by one. So the first thing is cash gift of 75,000. So 75,000 is received from a friend. So cash gift is taxable. Cash gift is 75,000. So since it is more than 50,000, it is taxable. Next is bullion. Bullion is taxable because it is more than 50,000. That is fair market value is more than 50,000. So you have to write it as a note. You have to say that bullion is a property as defined under income from other sources. That is as defined under section 56. So now you have to say bullion is a property defined under the section 56, and considering that the fair market value is more than 50,000, the value or the fair market value shall be treated as income from other sources. So that is for bullion. Next is land. So land is 5 lakhs, right? So land 5 lakhs. For this also you can write saying that land, since it is without consideration, whatever is the receipt is taxable. Next is A purchased shares. Okay, A purchased shares. The question is, he is a dealer in shares. So even if there is a difference in the fair market value and the purchase, whatever it is, even if there is a difference between the valuation, since he is a dealer in shares, it is happening in the regular operations of business, hence need not be considered. So whatever value of shares you'll have to say nil and explain there that Mr. A is a dealer in shares, and since it is during the course of business, whatever has been purchased is not taxable under the head income from other sources. So that is for your thing. And then what happens? Difference between this property, that is Mr. A took possession of a property. So he is a buyer. He is a buyer of a property booked by him 2 years back. At that time, 20 lakhs. He has paid 1 lakh. So whatever is the difference, since he has paid 1 lakh by account paycheck, the relevant date is booking date. So 23 lakhs. But he's booked it at 20 lakhs. So 23 minus 20 lakhs. So property booked, correct? So here 23 minus 20 lakhs, because 23 is the stamp duty value on the date of sale agreement. So this also you have to write a note. How much is it? 3 lakhs. So your income from other sources will be 135, 635, 9 lakh 35,000. So this will be your So this will be your income from capital gain and other sources. So clear, any doubts on this? You may just proceed on to ask. So for income from other sources, it is 9,35,000. And for capital gain, it is 2 lakhs. So that's about your exercise 3. Okay. Next thing, exercise 4. Discuss the taxability otherwise following the answer of recipient under the heads under 56 to 10. Akil HUF. For HUF, members of HUF or relatives. So HUF receives 75,000 in cash from niece of Akil, that is daughter of Akil's sister. Akil is the karta of HUF. So we said for HUF, the taxability is what? Only with the member. But here, daughter's daughter, right? Niece of Akil, that is daughter of Akil's sister. So which means they are not member. They are no more member of HUF because she is not a member. So since she is not a member, the 75,000 will be taxed. The 75,000 will be taxed. So 75,000. Next, Nitisha, a member of her father's HUF. So she is a father's HUF, transferred house property to the HUF without consideration. The stamp duty value of the house property within the member of HUF and HUF. So it is not taxable. So we can say it is not taxable. Mr. Akshat received 100 shares from A Limited from his friend as a gift on occasion of his 25th marriage anniversary. The fair market value is something. So whatever it is taxable, right? It is taxable. How much is taxable? He also received jewelry worth 45,000 from his nephew on the same day. So what happens here? So now the valuation of debt, that is 100 rupees per share. The fair market value is 100 per share. So 100 into 100 is 10,000 plus 45,000. So 55,000 will be taxed. So 45,000 plus 10,000. Kishan HUF gifted a car to son of Karta for achieving good marks in 12 board. The fair market of the car is 5,25,000. Two reasons. First reason is definition of property. Car is not a property. So when you gift a car, it is not taxable. But car is, next thing is, it is also between HUF. So by base itself is not taxable because car is not a property. Even if it had been a taxable property, it will still not be taxable because it is between the member of HUF and HUF. Okay, we'll move on to the next question. It's basically Hari, a property dealer, sold a building in the course of business to his friend. Who's a dealer in automobile. So the business of the friend is automobile for 90 lakhs on 1st January 2023. So it is sold on 1st January 2023. When the stamp duty value is 1,50,000. That is 150 lakhs. So it has been actually purchased for 90 lakhs, whereas the consideration, the stamp duty value was 150 lakhs. The agreement was entered on 1st September 2022 when the stamp duty value was 140 lakh. So what date? 1st January 2023 is registration date. 1st September, right? 1st September is agreement date is 40 lakhs. But in that case, Hari had received a down payment of 50 lakh by a crossed check from Rajesh on the date of agreement. So it's a crossed check. So what is relevant is 140 lakhs. So 140 lakh is what is relevant. So we have to consider only that. So which is basically, we have to see whether it is a sale of agreement date or the thing. The only thing is here it has been referred as something called crossed check. Crossed check. So what typically the question says is, provision says account payee check. So we can take an assumption that this cross check was not an account payee check. So from Rajesh on the date of agreement, discuss the tax implications from Hari, assuming that Mr. Hari has purchased the building for 75 lakh on 12th July 2021. Okay. And there is another question which says, would your answer different if Hari was a share broker instead of property dealer? Okay. First, we'll see from Hari's perspective. Assuming that he is a property dealer. Okay. Assuming that Hari is a property dealer. Now, the first thing is, as far as Hari is concerned, he sold a property. So as far as Hari, we have to see whether section 43CA would attract. 43CA says when building represents a stock in trade and he has transferred, it has to be transferred within 110% of the stamp duty consideration. So even in 43CA, similar to 50C. So both 50C and 43CA talks about 110% of consideration. So for stock in trade, it is 43CA. For capital gain, is 50%. So what is the stamp duty value here? Whether date of agreement or date of transfer. We have to take 150 lakh, that is date of registration, because it is paid by crossed check. So now it is 150 lakhs. So your SDV is 150 lakhs. Now how much is consideration? There is 110% of consideration, 90 lakhs, 99. So 150 is greater than 99. 150 is greater than 99. So automatically, whatever he purchased was 75 lakhs. So your PGBP income, your PGBP will be 150 minus 75. That is 75 is cost, 150 is your sale. So the 150 lakh will be treated as sale. 150 lakh will be treated as sale and not 75 lakhs. So what happens is the 75 lakhs will be treated as business income in the hands of Hari. That is in the hands of Hari. What about Rajesh? Rajesh is only dealing in other business. So if it's in other business, we'll have to see sale consideration stamp duty value on the sale consideration. We have to see 10% of sale consideration or 50,000. Okay. We said there is a cutoff of what? 5 lakh. Now it is all 75, 90 lakhs and all. So it is straight away 10% of the consideration. Now your stamp duty value is 150. Your sale consideration is 90 lakhs. Your sale consideration is 90 lakhs. So your 10% is 9 lakhs. 9 lakhs. But the difference is 60 lakhs. Difference is 60 lakhs. So the 60 lakh being the difference between stamp duty value and the property value, that is sale consideration, will be treated as, so stamp duty value minus sale consideration, that is 150 lakhs minus 90 lakh. The 60 lakh will be considered as an income into the hands of Rajesh. So that's what we need to do. Now again, here also, should we take date of registration or date of agreement? Since it's a crossed check, not an account pay check, what should be considered as 150 lakhs? Now, what if Hari is a dealer? Hari is a dealer. In this case, in capital gain, while computing capital gain, he has to compute the whatever is the difference between, that is 150 lakh and 75 lakh would be chargeable as a capital gain. Now, Hari actually sold it on 1993, but he purchased it. He had actually purchased that property on 12th July 2021. So it is 2021 and he's actually selling it in 1st January 2023. So it is less than 2 years. So it will be treated as a short-term capital gain. In short-term capital gain, we have to see this 150 minus 90, that is 60 lakhs. 60 lakh will be treated. And in Rajesh, no difference. Whatever it is will remain same. 60 lakh will be treated as thing. So that is about your gift. So this is one of the very important provisions of your income from other sources. Most of your income from other sources questions will be from this particular chapter. So we'll see if there are any questions that I need to answer. Abdul, if stock is converted into capital asset, so is it covered under this? No. Conversion of stock to capital asset, we already discussed in capital gain. Danish, yeah, if gift is 60,000, the whole 60,000 is taxable and not 10,000, correct? Pranav Vashishta, if the gift is given by a foreign person, see, as the provision says, the section, this entire section of 56.210 is only when a person receives. So it doesn't talk about resident, non-resident and all. So a person receive only is discussed here. So even if the gift is given by a foreign person, it is still taxable. And then 110%, yeah. Rama, can company give gift to shareholders? No, because there's nothing business about it. It's personal. Company cannot make any personal expenditure. If it is a personal expenditure, it has to be disallowed. No, there are no additional amendments after this issued by the ICAI. Yeah. So good. There are no more questions. So what we'll do is we'll continue with the next provision of interest. The last one that we need to discuss. Interest is very simple. I'll not take you through more things. So basically, okay, now we will come to the area of not chargeable under. We have covered everything what is charged under other heads. What is not chargeable under other heads is basically these things, these four things. Any sum received by employer contribution. So employer receiving contributions from employee is taxable under IFOS, if not taxable under PGBP. Don't ask me what situation it will be and all. Almost none, because whenever there is a PF contribution, there must be an employer-employee relationship. Very rarely or hardly there will be a situation where it is not there. So it is purely theoretical. Just that remember, if there is a PF contribution received by the employer from its employee and it is not covered under PGBP, then it will get covered under here. Machinery, plant or furniture hire, it might be a business income. If not, it will be taxable under here. So it might be PGBP. If not, it will be taxable under IFOS. Income from letting of machinery, if building is inseparable. If rent of building and machinery plant is separable, then building will be taxable under house property. This will be taxable under income from other sources. If not, put together, it will be taxable under income from other sources. So only when building and the rent of building and other assets are not separable, is not able to separate. Keyman insurance policy, including the allocated by way of bonus and such policy. We have already seen this in PGBP also. So if it is taxed under PGBP, yes. If not, it will get covered under this situation. Interest on securities, section 56(2)(d), and some of the interest is exempt. So post office interest up to 3,500 in case of individual, 7,000 in case of joint account. So post office savings account is taxable. Some portion of it is exempt. The interest on deposit for the victims of Bhopal gas leak. All these are theoretical. Okay, let me not spend much time on this. So you can go through these and understand what is exempt and what is taxable under interest. Residual income. If nothing is covered under any other head, then it will get covered under this head. So what do you mean by that? For example, salary received by an MP or MLA. Salary received by MP or MLA. It is not taxed under salary. So it is taxable under income from other sources. So these are specific heads, which though it as if looks like it is taxable under salary, since it is not covered under there, you cover it here. So salary received by an MP, MLA will be taxed under income from other sources. Interest from non-SLR securities. So non-SLR securities is a type of security that banks maintain. So for this, RBI has clearly said that this interest is part of their business income and not income from other sources. So here, this will be treated under PGBP, not under, though it is an interest, it will be treated under PGBP, not under income from other sources. These are two particular examples given in your institute study material. So generally, an income will be covered under respective heads. If it is still an income but not covered under respective heads, it will be covered under income from other sources. What is deemed income? Whatever is discussed in 41(1). So basically, during any previous year, if the liability ceases to exist, if there is a remission or cessation, then it becomes an income. So whatever we discussed in 41(1) will be applicable for income from other sources also. So next is what are all the expenses that are allowed under section 57. We have covered 56, everything. Now we'll move on to 57. Income from dividend. Interest expense, interest income to earn interest expenditure. Okay, interest income to earn such expenditure subject to 20% of such income. So your interest expenditure cannot be more than 20%. So if you are actually having a dividend income, you can reduce interest expenditure on loan obtained, but that interest expenditure cannot be more than 20% of such income. So that's what it is about. Income on interest on securities. Any reasonable sum paid by way of commission or remuneration to a banker or any other person of realizing that interest income can be reduced. Interest from contribution from employees, whatever is being paid by that employer to the PF organization can be claimed. So PF is being collected from the employer, from the employee, deposited to the government. So collecting is an income, depositing is an expenditure. If this is not covered under PGBP, it will be taxed under IFOS. Income from letting out, we already saw. Whatever you have rentals paid. So current repair will be allowed. Any premium paid on insurance is allowed. Similar to what section? 30 and 31. Regular depreciation. So this is 32. So these two is 30 and 31. So we said rent, rates and taxes, insurance. Now what we are trying to say is, we are trying to say repair and rent alone is allowed. Repairs and insurance. So repairs on machinery, plant finishing, insurance. So these two alone is allowed, similar to what we discussed in 30-31. So not rent, not rates and taxes. Repairs and insurance alone is covered under section 57 for income from letting out. So then income in the nature of family pension, it is 1/3 or 15,000, whichever is less. However, if it is received by armed forces, it is completely exempt. Similarly, if it is receipt of gallantry awards, that is Paramveer Chakra and all those things, right? So if you are receiving any family pension on recipient of gallantry awards, that is also exempt. Any other expenditure not being capital laid out, expended wholly for making. So this is general for all clauses. So if there is any other expenditure which is wholly and exclusively earned for earning this income from other sources, that will be exempt. Now, when we discuss what is allowed, we should also understand what is not allowed. So any personal expense is not allowed. Any interest or salary payment which is on which tax has not been deducted, it is payable outside India. Any foreign payments, interest or salary, if TDS has not been deducted, it is not applicable. And provisions of PGBP, the 30%, that is TDS provision. TDS provision where 30% of expenditure will be disallowed under section 40 clause A will be applicable here also. Similarly, 40A to B. So this is 40A 1A. This is 40A 2B. And this is 40A3. So 40A2 and 40A3 is applicable for income from other sources also. For horse races, you cannot claim any expenditure. So whatever is incurred for that, owner of horse races alone can claim expense. Any other casual income, we said no expenditure, but only for horse races can claim expenditure in respect of owning and maintaining that such horses. So that is what is there. For every other else, for no other casual income, expenditures are allowed. So that's what it is about. So any doubts so far? We have covered all the provisions as such. I only have few problems, and other than that, I think I've covered every sections. So if there is any doubt, please let me know. Vedantara, gift of anniversary will be exempt? No. What we said is gift at the time of wedding of the individual. So if my wedding, on the wedding date, I am receiving any gift, it is exempt. But for my first year anniversary, fifth year anniversary, everything, there is no exemption. So it is only on the wedding date, not anniversary and all. Wedding date of that individual, not my brother's wedding, son's wedding. No, it is only wedding of that individual. On that date alone is exempt. Dhyanesh, yes, this is the last session of this batch. So this is my last session for this batch. So I will not be covering any other rest of the portions. So I will just take some more time to just cover one of the exercise problem alone. Examine under which sets the following income will be taxable. So the rental income. So the rental income in case of property held as stock in trade for 3 years. So it is not income from other sources, correct? Because it is specifically covered under other area. So it is income from house property. So it is not covered here. Dividend on shares in case of dealer in shares. Dividend is straight away taxable and income from other sources because it is definitely chargeable under income from other sources. So that is for dividend. salary received by a partner from his partnership firm. It is covered under profit and gains from business or profession. So whatever salary is received by a partner is taxable under PGBP. So this is HP, this is IFOS, and this is salary received by a partner is PGBP. Rental income of machinery. Rental income of machinery is what? Rental income of machinery, it is either PGBP or IFOS. So if not under PGBP, then IFOS. Winnings from lottery is specifically IFOS. There is no PGBP. Salaries payable to a member of parliament is residual income, is technically under income from other sources. Receipts without consideration is IFOS. So there is no alternate. In case of retirement, interest on employees' contribution, if provident fund is unrecognized, interest on employees' contribution. So whatever is interest on employee contribution will be taxable under IFOS because it's an interest. Rental income in case of a person engaged in the business of letting out properties, business, okay, then it is PGBP. They are in the business of renting it out. So that's why it is covered under this. Examine whether the following are chargeable to tax and amount liable to tax. A sum of 1,20,000 is received as gift. Is received as gift from non-relatives by Raj on the occasion of the marriage of a son Praveen. Son's wedding is not allowed. Only in this own wedding, that is self-wedding. Only for that it is relieved. So it will be taxable. The entire 1,20,000 will be taxable. Correct. Next is interest on enhanced compensation of 96,000. 50% is considered as exempt expenses. So the balance 50% will be taxable. So out of 1,96,000, 48,000 will be taxable. So in this 48,000 will be taxable. In this entire 1,20,000 will be taxable. Clear? So on October 10, 2022, Mr. Govind received 5 lakh towards interest on enhanced compensation from state government in respect of compulsory acquisition of his land affected during the financial year 14-15. Out of his interest, 1,50,000 relates to financial year 15-16, 165 to 16-17, 1,85,000 to 17-18. He incurred 50,000 by way of legal expense to receive the interest. Now, how much of interest on enhanced compensation would be taxable? Please understand, whatever is received, straight away 50%. So this 50,000 and all is not additionally allowed. So flat 50% is allowed in the year of receipt. So the entire 5 lakh, irrespective of in which year they have received, the entire 5 lakh will be taxable at 50%. So how much? 2,50,000. 2,50,000 will be taxable. How much is it actually? 1,50,000, 315, 415. Yeah, 5 lakhs, right? So the entire 5 lakhs, 50%, that is 2,50,000. You'll have to specify that in accordance to section 145B, interest and enhanced compensation shall be deemed to be the income in the year of receipt, irrespective of the method of accounting followed by the assessee. So that should be specified. And in according to section 57, 50% of the interest on enhanced compensation shall deem to be the deduction for interest on enhanced compensation. So the taxable income will be 2,50,000. That is 50% of 5 lakhs. Kavita, what is enhanced compensation? Enhanced compensation is compulsory acquisition. We have already discussed this in capital gain. A particular land or building is compulsory acquired by the government. For that, a compensation is paid to the seller to the person from whom the property is acquired. If additionally there is an additional compensation contributed by way of demand or court case, then that is called enhanced compensation. If there is any doubt, you can go through this capital gain chapter. Okay, I will not cover this exercise 9 and 10. I have 2 more exercises. I will not cover. Rather, I will cover few MCQs, okay, few multiple choice questions and complete. So, Mr. Kashyap, Kashyap has acquired a building from his friend on 10th October 2022 for 15 lakh. The stamp duty value of the building on the date of purchase is 16 lakh 20,000. So we have to see whether the difference between fair market value and minus consideration. So how much is it? 16.2 minus 15, that is 1,20,000. Okay. So how much is 10% of, is this? This is lesser than 1,50,000. What is less 1,50,000? It is 10% of 15 lakhs. Above 5 lakhs, you can ignore 50,000. You can straight away take 10%. So our 10% of 15 lakh is 1,50,000. So the difference is less than 1,50,000. Difference is less than the 10% consideration. So in this case, what happens? There is nil. So nothing needs to be taxed. So the answer will be nil. Mr. XA61 receives dividend of 12 lakhs from ABC Limited in previous year 2023. Interest on loan taken for the purpose is 3 lakh. So interest he has paid is 3 lakhs. Okay. So out of 12 lakh, how much can I allow? Out of this entire interest expenditure, how much is allowed? Only 20% interest is allowed. So my expenditure, my income will be 12 lakh minus 20% interest, 20% of dividend income. That is when I say 20% interest is restricted to 20% of dividend income. So my dividend income is 12 lakhs, 20% is 2,40,000. So how much is allowed? Only 2,40,000, not 3 lakhs. So my interest expenditure is maximum of 20% of the dividend income. So 12 lakh minus 2,40,000. How did I get this 2,40,000? It is 20% of 12 lakh or 3 lakh, whichever is lower. So I take 2,40,000. So 12 lakh minus 2,40,000 is how much? 9,60,000. So answer will be 9,60,000. Next one is Mr. Mayank has received a sum of 75,000 on 24th October 2022 from his friend on occasion of his marriage anniversary. Is it allowed? Not allowed? Occasion of marriage. So typically marriage, wedding is allowed, anniversary is not allowed. So 75,000 is chargeable to tax, 75,000 is exempt to tax, 75,000 being 1/3 is chargeable to tax, 50% is chargeable to tax. So basically the entire 75,000 is chargeable to tax. Next one, Mr. Kishore celebrated his 50th marriage anniversary. On the occasion, his wife received a diamond necklace of 5 lakh from Kishore's brother. So relative, so not tax. Kishore's son gifted to him a luxurious car. Car is not a property, so not taxed. His grandchildren gifted them a new furniture. Furniture is not an asset, not a property. Also, he received cash gifts from his friends of 80,000. Now, which of the following is true? Neither Mr. Kishore nor Mrs. Kishore will be taxable for any gifts. Is this true? On marriage anniversary? No, because on marriage anniversary, the gift is taxable only. But it is received from relatives, so it was not taxable. Mr. Kishore and Mrs. Kishore will jointly share the tax liability on all gifts. False. Mrs. Kishore will be liable to pay tax on diamond set. No, because it's from relative. Mr. Kishore will bear the tax for the cash gifts. That part is true, but Mrs. Kishore will not pay any tax. So last one, Mr. Kishore will be taxed only for the cash gifts. Yes, true. So what will be taxed only will be 80,000. And nothing else will be taxed because car is not a property, furniture is not a property, 5 lakh is from a relative. A lady received the following gifts during the month of December 2022, 90,000 from her elder sister, not taxed. 60,000 from the daughter of her elder sister, yes, it is taxable. And 1,25,000 from various friends on the occasion of her marriage, so not taxed. So what is taxable only is 60,000 because 1,25,000 is on the occasion of wedding, not taxed. 90,000 is from her elder sister, not taxed. So 60,000 from her elder sister, daughter of elder sister only is taxable. M, an individual receives the following gifts previous year 20, 22, 23, 24,000 each from 4 friends. So each of them is paying 24,000. So it is 96,000. So it is above 50,000. It is taxable. Wristwatch is not an asset, is not a property. So what will be taxed is 96,000. In July 2022, Mr. Parvesh, employed as marketing manager in pharma company, received a bike as a gift from a distributor of the company. The value of the gifted bike is estimated 48,000. Which of the following statement is true? The value of gifted vehicle is less than 50,000, hence not taxable. Vehicle is not a covered property. Mr. Parvesh, being an employee, it is taxable under salary. Any sum of money or property without consideration is taxable, hence the gift of bike is taxable. Here, Parvesh is employed, but the gift is received from distributor of the company, not from the company. So, if from the company it is perquisite, here is distributor of the company. So, what happens is, it is basically value of gift vehicle is the value is not covered property, hence it is not taxed. A land owned by Mr. X was acquired by Railways in 2015, so it's compulsory acquisition. So 2 lakh, 3 lakh 10,000, 4 lakh 20,000. So out of 4 lakh 20,000, how much is taxable? 2 lakh 10,000 being 50% of interest received, because 50% only is taxable, correct? So I think I've covered everything. So let me know if you have any questions. Pranay Vashita, reduction in capital. See, reduction in capital is reducing the face value from 10 rupees to something else. Let's say 6 rupees or 5 rupees. Settling the balance to the shareholder to the extent it is contributable to accumulated profit. In the particular slide, there is an example. Whatever is that is the reduction in capital. So that will be treated as a dividend. So I think it is clear for all of you. And thank you, Danesh, for appreciating the way I teach. So I thank each and everyone for happily attending the session. I'm not sure whether I have a session on 8th December. I think today is my last session. Anyways, I'll check the schedule once again. So with that, thank you. I thank each and everyone for attending my session. So we'll see in the next phase of coaching classes. So thank you all for the wonderful session.